sometimes there's been a bit of a blanket that's been thrown over private real estate credit and private credit, and there are some subtle differences. For example, with real estate credit is you're lending against a hard asset being underlying property, and that property generally is quite easy to value. You can employ an independent valuer who can look at comparable sales and other discounted cash flow analysis to give a pretty good understanding of what the value of that hard asset is. And why that's important is that, look, on occasion, a private credit loan may go into default, and then you have to look at the underlying security. How is that loan secured? Well, secured by a mortgage over property. So being a lender, you can enforce that security and try and recover some of the capital or the funds that have been lent to the particular borrower. Now, the other difference would be more broadly in private credit is they're lending against businesses. And these aren't like BHP or Commonwealth Bank, which are what I'd call investment grade businesses that issue bonds and they're rated. These will be typically second tier businesses, probably very good quality businesses, but they're not listed on a market, so they're difficult to value, or more difficult to value, and they're not rated by Standard & Poor's or Fitch and Ratings. So we'd call them sub-investment grade companies, not to say they're not very good quality companies. But you're then looking at the hard assets of what that particular loan is secured against, and typically they're unsecured. So what I mean by that is that they're secured by the cash flow of that business or the brand name or the goodwill. However, if that business, say, falters and you need to enforce your security, there is generally no hard asset there. So you might be saying, oh, there's some inventory, but it might be inventory that they weren't able to sell and is not worth anything, or there's cash flow. Well, if the business has had a downturn and there's no cash flow, they're unable to service that loan. So what we're trying to get across is that there's subtle differences between property credit and just general private credit. Probably there, in our opinion, we think there's probably less risk when you've got a secured hard asset underlying that loan. Therefore, do you require, what return do you need to get? So if we're giving, say, 10% for a first mortgage security on a secured asset, if you're going to private credit generally, you've got to ask yourself, what sort of return do I need for an unsecured loan and to take on that risk?